Hello, I'm Darius McDermott. I'm here to get an update on the Liontrust Special Situations Fund managed by Anthony Cross. Anthony, given the current macroeconomic background, why should we be investing in UK equities?
Well, there's some fabulous businesses you can invest in the UK. About 70% of the FTSE's earnings are in overseas businesses. So there are so many companies, from engineering to pharmaceuticals to big consumer goods companies, where we can get some real growth. So it's not all about the UK consumer, it's about where you can take a UK business overseas.
And is that replicated in your Special Situations Fund?
A lot. We have about 64% of our sales from our businesses in the Special Situations Fund are overseas and in many fast-growing markets.
You also have quite a lot of smaller and mid-sized companies in the Special Situations Fund, and you have historically for a long time run a small-cap fund. Are small companies generally riskier in this volatile market conditions?
Yeah, it's interesting you say volatile, because the way that a lot of people look at risk in the markets is by using phrases like beta or risk on and risk off. The way we look at the risk of businesses is to look at the danger to an individual company. And that can be product spread, customer spread, financial gearing, how developed your marketplace is. And we find that many of our smaller companies are as risky or as less risky than many of the mid-cap companies and even some of the large companies. They have a broad product spread, they have a good customer spread, they have a good geographic spread, many of them have got net cash on the balance sheet, so they're not very risky businesses. The danger is, of course, that share prices can drop, but it doesn't necessarily mean that the business is having a tough time.
You would, I imagine, also have some liquidity issues on the small cap side as well, and I would also think that some companies come into your valuation range when markets are falling. Some small companies or mid-sized companies that you have been sort of waiting to buy but have been expensive.
Yeah, I mean, a couple of good examples recently is a share in a company called Craneware has been coming back due to fears about its overall growth rate, but it's still a fantastic business with very, very high recurring income and lots of intellectual property, so we've been buying more of that. The same with another company called NCC, an internet security and software escrow. They had to write off an investment in Workflow, SAP, that they'd been trying to put into the business, and the shares came back, so we picked up more of that because it had nothing to do with the fundamentals of the business.
Could you give me a brief outline of the economic advantage process?
Yes, it's a process that's been going on for a long period of time, and what we're trying to do is to capture businesses with very strong barriers to competition. And our belief is that you get a strong barrier through your intangible assets within your business. And there's three that we think are very, very powerful. The first is intellectual property, the second distribution networks, and the third high recurring income. And you've got to have one of those to get into our portfolio. So that's sort of part one. Part two is then to say, well, we want these barriers to competition to produce a strong financial return for the company. So we look at the returns on the cost of capital in the business, and we also look at the margins in the business. And what we find is that that helps us evaluate whether the barrier to competition is working. Are you producing strong financial returns? We then have to make sure we buy the company into the fund at the right price, and then think about the risk of the business and how much we want to have in that individual holding.
What's your view on dividends? Do you prefer companies that pay dividends?
The interesting thing is that with many of our companies, because of their barrier to competition, their pricing power, their sustained profitability, the cash flows are good and the ability to grow your earnings is strong, and therefore the dividend payouts have been going up very nicely. So we have a very good profile of increasing dividends from our companies. We think dividends are an important discipline, and it's nice to see, particularly in your small companies, that the companies are coming through and starting to pay dividends, because that shows they're growing up. So although we're not a sort of income fund play, we do have a very nice characteristic in terms of dividend growth rates within the companies we hold within the fund.
We spoke briefly about overseas earnings. Maybe you might give us an example of a company which has strong performance or strong delivery from overseas earnings.
Yeah, I mean, we've got lots, and that's the fantastic thing about the fund. One of the great examples, that's quite topical, is Diageo. You know, over 85, 90% export business, just putting £1 billion into investment in Scotland to increase the whisky production. You know, a classic exporting business where the distribution networks have been set up hundreds of years ago, often by the whisky barons in the 1800s. It's a company that's moving into Asia more, into Africa more, into Latin America more. It's a classic exporting business, and it shows why investing in the UK market can be very exciting.
Could we also have an example of a company which derives most of its revenues from the UK? This is a Special Situations Fund.
Yeah.
There must be a couple of UK Special Situations out there as well.
There are, but they tend to have often very high recurring income. So they might be found in the software space. A nice example of a company which floated last year is called Smart Metering Systems, and that's involved in the asset ownership of gas metering, high recurring income, and they've also developed intellectual property in a new device for gas measurement. So, a nice example of a pure UK company that's been doing really well for us.
What changes have you made to the fund in the last 3 to 6 months?
We don't make big changes. The style is find these companies with strong barriers to competition, let them work for you. We don't need to have high turnover in the fund. But if you look over the last year or so, we've had a new holding called Progressive Digital Media that's come in. Diageo came in at the beginning of the year. Smart Metering Systems was afloat last year. So we do find new companies coming in. Often they get they get bought into the fund because we've had other companies taken over, and that creates a gap. But low turnover, I think, is a sign that the process works for you.
Thank you, Anthony, for the update on the fund.
Thank you.